Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. From our last broadcast, I've had many calls and people talking about what they should do with their deposit rates in here. As we talked about last week, and we've had a move up in T-bill rates. In fact, the 3-month T-bill moved up from a 0.01 to a 0.02. The 1 year up to a 0.17, back down to a 0.16 in here. Still, you look at even longer rates with the 10-year Treasury at a 3.16, and we made the comment last week that essentially should banks be paying the rates on savings and money markets that they're paying right now in relationship to money market funds. And the commentary talking to other bankers is that they are seriously considering dropping their rates on these deposit products. For instance, one banker I spoke with this morning, that their savings rate right now at about 0.25, they're looking to bring it down to somewhere between maybe 0.1 and 0.15. So when we look at that, we really have to, as we talked about last week, look at the risk premium. And what we've attached today is an article that I wrote looking at this whole phenomena of a static Fed situation going forward, where T-bill rates are, and then also listing where the majority of top money market funds are out there. And once again, it doesn't approach nearly the level that most banks, even offering FDIC insurance, are offering on these kind of deposit products. So when we look at it, we can look at it as pricing strategy, that there may be more to go in terms of how to price yourself. How do you do this? How do you put together strategy around this to move through this particular point in interest rates? How far do you need to go in order to maintain your net interest margin overall, based upon the fact that the majority of bankers, while they were talking about they still have deposit inflows, that really the lending piece is slowing down in here. Where in some areas of the country we saw lending picking up at the beginning of the year, it seems wherever I go, I hear that lending is slowing down in here, banks having trouble reinvesting their overall portfolios. So we look at it in terms of investment strategies, for instance. What do we do in here? How do we put it together? What Dr. Ed and I feel is very important here is that we're going to, at the end of this month, put together essentially an ALCO meeting. This is going to be broadcast to our subscribers for a performance risk report, and that we are going to send them both from the standpoint of a webcast, but we're also going to send it in overall transcript form, so that it depends on how you want to get this information to your directors, to your members of ALCO, to the senior management members, that essentially you can do it in a number of different ways. Because the key in here is strategy. So what kind of investment strategy should you be looking at? Especially with the fact that when you look at, say, like mortgage-backed securities in here, at back to just nosebleed type premiums, looking at the fact that the duration risk is very heavy on these securities if interest rates start to go up. Can you look at a mix, for instance? One of the things that we've looked at is a mix of corporate bonds and tax exempts, where you can remain short with the corporates, offset the yield on the tax exempts, and essentially be able to produce something that's not going to have significant duration risk. How do you look at that in relationship to how you price these deposits? How do you look at it from the standpoint of which way your local and regional economies could be heading in here? So we want to take into account all of these different things as part of a very dynamic ALCO presentation that can be used to really plot out how we go forward in this environment. What risks do we want to be taking? How can we offset risk? And when we look at that, is that it comes back to, do we have room on this deposit side to be able to really move these deposit rates down? This is Jay Brew, co-chairman of Seafried and Brew. Have a good week.